Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update. We'll update you on the current state of affairs with the earnings trades. We had one new study that we have published, so talk about that briefly, and then Joe's got some comments following all of that. So that's the plan. Is there any questions before we get started? Nope. All right. So let's get going. So everything, major indices are in state 7 here. Not much change as far as the states. I did see XLU utilities popped into state 1. But other than that, the currencies, UUP is still in 1, but you're seeing a lot of, these were in 8. So some of these are starting to flip, which is like a weakening of the dollar. But, we'll have to see how that pans out longer term, but could just be short term. So, I mean, the key thing here, we talked about states like state 7, these all just came out of the bottom, the 8. So it's, pretty critical right now whether these things go into like state 5 or state 3, or if they go back to 8, then that's really bearish, because that just establishes that 7-8 downward trajectory for stocks. And I'll pull up the Russell just real quick to show you. So like here we've been in the 7-8 for a while. This one, it's definitely been uglier than SPX, but as far as the XPX here, that was the first 8. So kind of key here, coming off the bottom, and if you look at the previous ones, coming off the bottom, 8, 7, 5, then resumed its 1, 2, 1, 2. This is very bullish. You run up, you pull back, run up, pull back. So it's kind of want to highlight that, kind of key things to watch with the modeling here. Overall green pie, obviously getting a lot more green. So we're at 70. We're not oversold. I mean, overbought. The overbought's only when we're in state 1 above 45%. So we're nowhere near overbought, and we're definitely not oversold. So we're kind of in the middle. And as we walk through, and you can go back in the time machine and look at previous bottoms. I'm not saying it's the bottom yet, but all these things start shifting, 7 to 5, or 7 to 3, and then from 3 to 1, 5 to 1. That's kind of how things build up into the really bullish states. So right now, we're seeing a little bit in 5s, but majority have just shifted from 8 to 7. So kind of key areas here just to watch. See if they start reverting back to 8, or start transitioning into 3 and 5. That's the primary place those will go. So let's take a look at the this is the state. So this is state 8 up top. Obviously huge drop. State 1s are starting to build a little bit here. So but the 8s have really dropped off. And we had a big drop off back here, where it turned around. So obviously we're deeper here than the previous drop offs. The lows, just so you can, you can click on different things. So you can pull up like state 7s. There's a whole key here. Obviously, this to kind of monitor or check out other states and things like that. 7s might be interesting to kind of look at. You get these blips in the in the 7s. A lot of those have been tops on the way. Since our bearish market started back here in like the November timeframe. So those 7s have been kind of these rallies have really been, the tops in the market. So that's just something to be careful for. I'm not sure it's going to be a top here, but that's just one indicator. and you have to put them all together here. Let's look at bullish bearish. So here we crossed over, had a real strong crossover. So we're well above any of the previous highs year to date. For the bullish bearish, a lot of those that we talked about are going to be in this state 7.5. So, it's hard to call any kind of, any kind of top, just based off of, this kind of market pulse, just because, these could easily go from 7 to 5 and there won't be any change, in the percentages. So that's why we look to that state 1 as the overbought, and we look just for oversold with this overall market pulse. Anything below 30, you're going to get like a temporary, should get a temporary rebound off of that. But, so strong, and we talked about that, if we could stay above 50, we expect some good movement. And, so that's what it's done. It's held up there, and, it's just another kind of indicator to keep your eye on. The lows and highs, you can see the new lows, pretty much nothing, flatlining, that's very bullish when we have known spikes. So just, be on the guard for, how it's been going. We've had this March rally, that was longer than most people expected, where we had pretty good flat line and the new lows, and, and then things started to get jumpy again. So this one's been a similar type of rally, and we just have to be careful, just based off of fundamentals. I'm not like an ultra bear or anything like that. It's just, the fundamentals of what the Fed's doing. You just have to be very careful, as they raise rates, and, when they actually start to taper, which, we've talked about, and I can elaborate on that in a minute. So that's overall the market pulse. Let's take a look at SPX. So state 7, fairly short state with only 13 days. Obviously our key levels, pull them up here, target 3 up here. Key level to watch at, 41.55. It pretty much bounced right near that support, kind of turned south and then bounced off this support level down here, and just rocketed up all the way up to our target 3 area. So it's your key level to watch right now on SPX, to see if we can get above that 41.55. I haven't looked at, the current price, so we're right at it, 41.55. So, just a key thing to watch there. But I think even more important is, our critical levels. Now, let me just draw them up here real quick. So we're, right near the top of the current range, with the 4,200, and then the bottom's at 3,800. So we're getting, that's even more important. You can see the last time, we were in this kind of vicinity, it just pretty much showed really strong resistance. That also coincided with the 50-day. So you can see the 50-day here, basically, went up above, tried, and then bounced off pretty hard. So that could be support, going forward, hard to say. But, I think 2 key levels to watch, 4,200, then obviously that 41.55, the target 3 right here for SPX. So I think that was it for SPX. Let's pull up Russell. Similar story, but didn't get all the way. Hold on. Didn't get up near target 3. This one's have problems right above target 2, and the reason that is because that's 1900 area. So we've talked a lot about this, and I think it's more important to pull up this chart here. and the state modeling for first. So this is that 1900 here, that kind of key line. So that's the upper end of the current range. The bottom is at 1700 range. So we're right at it. I think we're right above it right now. So I think this is the most critical thing to watch currently in the market. Can we get above this 1900? Here's the last attempt. It did close above one day, next day down below. So right now I think we're still above it, slightly. So just over the next few days, I mean, that's key level. This one went back a ways, that 1900. Let's see if we can pull it back even further. I lost the 1 second. There we go. Yeah, so this one goes back a ways. So those are the key things. The Russell there, obviously, that 1900 is right in the middle of this target 2 and 3 range. So that's what I'd really be watching. It's starting to show resistance here, on the chart there. The last time you can see the resistance really starting to form right in here. So we've had a few days here. Could repeat here. So that's just something to really be on guard for, that 1900 there, and then those kind of key levels. SPX a little falling behind as far as that 4200. But so the first one up would be Russell, and I mean it's right at it, and the SPX is right at target 3 for this one, 4155. So those are the two key things. I don't have a crystal ball, so I don't know exactly which way things are going. I know in general it's still a downtrend, fundamentally. So that's what I'd always keep in the back of your mind. We've had rallies like this, and as long as the Fed keeps doing what they're saying. And oh yeah, we talked about the Fed meeting the other day. Obviously came out at 75. I think that's what everyone was expecting, so no big deal there. As far as the Fed balance sheet, they pretty much have done nothing since they've started. And there were comments. I don't know if everyone listens to the comments after the Powell talking afterwards, but he said the tapering, because there was a question finally at the end about tapering, and he's like, it's been basically slow to start. It's expected to pick up in September, whatever that means. But since May 25th, that's 89.14. We're down to we've 20 billion out of 9 pretty much have been taken off. So I call that a nothing burger. So they haven't even started tapering yet. They're not adding, so that's a different story. From the past few years. Here's your inflation spike right here. Thank you, everyone. And then just continue adding to it. So this infusion, and last time like we did these big infusions, they were to the bank. So this went to like the consumer. So everyone got money in their pocket for that one, but. I think that's part of the problem. Anyways, I'm ranting on about the Fed. So as far as the next, I haven't even looked at this. We're a ways off. Where's my Sadir? There it is. The Fed tool. September 275. So I think that's 50. Yeah. So 50 or 75, kind of right where it's at right now. Kind of monitor it, not much going on. I think, the next few months, because this is that Jackson Hole meeting, I think the next few months, really, it's just about, monitoring, some of them unemployment, but really focus on inflation data that's coming out, PCI and all those kind of reports. Those have really been moving the market, and that's the focus for everyone out there. What else? I think that was it on the market. Oh, Joe found this great calendar. So I'm just gonna put this in chat for everyone if you want to save it or not. This it's a great little tool. It gives you like a minute. It does a really good job updating. It gives you like, consensus market, just everything out there, and just an easy place to find, the different reports that come out if you want it or not. So I think that's it on the market. Thanks for Joe for finding that. I want to share it with everyone. Yeah, we're right above 19 and 41.55. So those are the things to watch. I'll open it up to questions or comments.
Josh, this is Winslow.
Hey, Winslow.
Yeah, I have a quick comment, and it probably Delphian doesn't do it. I don't know. Maybe I should ask Joe. If you draw a trend line of the SPX or the SPY from the high, and then there's another high, a descending trend line,
Yeah.
On the daily, we're getting closer to the point where the price might either bounce off that and go down, or else go through it. If it goes through it on the upside, would everyone and their Dutch uncle feel that it was bullish and we were off to the races again?
I would say it's a good probability. I wouldn't say it's a certainty. I've done a lot of that kind of trend tracking, but I would say, it's a higher probability. It's not like there's obviously no guarantees, but Joe, do you have a comment on that?
Not through the trend line per se. We've had a pretty good rally already. That probably will be a pretty good trend line, Winslow. I would kind of defer to the Fibonacci retracements, honestly, as the next level of resistance. Off the top of my head, where the 50%ers come in, I'm not sure, but that would be my first level for resistance, getting through that trend line. Excuse me, where that 0.5 and where that 0.618 come in.
Okay, sounds good. I get it. Yeah, thanks.
Mm-hmm.
Hey, Joe, and this is Dave. I'd like
Dave.
I think I vote for both Josh and Lee on that. Like the resistances, especially when we're not going to hear any news from the Fed for like a couple months now. So it's kind of a quiet period of time. And maybe you have put up the VIX chart, if you would, for me, a 1-year VIX chart. Show you that too. Sure. So, the trend is your trend until it's not. So right now the trend is going from like the odd Delphian numbers to the next best odd number kind of thing. And if the lack of news or the lack of so significant news, I think we'll keep that slow trend in place, and I think we might keep taking out the next high, the most recent highs that were kind of like the last point of resistance, if you will, to the next point of resistance, as long as there's no big negative news items that impact this until the next Fed meeting. And so draw a line. I'm looking at the VIX on the it's like reported live on Thinkorswim a little bit. So these two are a little bit different, but draw a trend line from the bottoms over the last 6 months of the VIX. Can you kind of do a best fit kind of? Yeah. There you go. And look at that, and look at where we are now. We're kind of like at the bottom of where that line is. That's what I've noticed.
Right.
So, and we're approaching what, 21 today, I think. 21 doesn't get below 20 very often in the VIX, but if there's not a whole lot of news churn, then the VIX will quiet down, because that's what it does. It's reverting to the mean kind of thing, right? That's what we know about the VIX. So that kind of supports this kind of bull rally that's in a who knows what market, whether it's a long-term bear market or we're already at the bottom and we're going to inch out of this. I don't know which of those we are in, but
Right.
this is what I see following. It's hard for me to predict where things are going to go in the next month or so. It's been sort of baffling to me. I thought we'd have a bigger turn to the downside with the last Fed, interest rate hike, and they're not really saying they're going to take the foot off the pedal as far as hiking goes, but that's what the market is believing. That's what I've been reading anyway. And I don't know, my sources might be biased on that. I don't know.
Yeah, I'm getting the same thing. They're already pricing in like definitely next year, the reversal. Some are even pricing in this year for the Fed policy.
So I guess we just got to wait and see. I'm kind of in a don't know what to do necessarily mode. I've gone from maybe a little bit less bearish trades to more neutral trades, but it's interesting to watch. I've noticed like I said from last time, I follow the chips, and that news has been breaking pretty much as predicted. Also, I don't see where this glut is coming in, where everybody's predicting a glut. But anyway, we'll see. I'll shut up. Sorry about that.
Yeah, no, I agree. I mean, it's a very difficult environment, just hard to, guess how people react. You get these, short squeeze rallies of, but that's a great point to show out that trend line increasing. I don't think that's a bullish indicator. In my opinion, definitely longer term bearish. If that continues, obviously, just more and more. We talked about that. The volatility increasing, and that points right to it. You had the bottom down there at like 15 in October, and now we're up. The bottom's 21. So that's a very high. Like where we talked last week. Typically we'd get down VIX 12 or 11, kind of flat line.
Yeah, look at the candlestick. Look at the candlestick heights. The median part of the candlestick without the wicks part, and look how much bigger it is from like November to April than it is in the last month and a half. It's they're all kind of like shortening them up, which is why the VIX kind of rises a little bit, or reverts to the mean a little bit, and it should be going down, right? So I say it should be going down in these last 2 months, but the bottoms keep rising. That's right. I'm pickle.
Yeah, very interesting. Good. Thanks for bringing it up, Dave. All right, I'll clear that. Anyone have comments on that, or in general on the market? No? Okay, we'll keep moving. Let me dive into earnings. Obviously, I like to showcase this now every week, our new user interface, which is coming in the future. But we're working on this daily. So okay, big news, bullish pre-runners done for the quarter. So there's no more trades. We had 12 in total, had a nice profit. Surprisingly, I'm not gonna lie, I was surprised. We had one loser, JP Morgan, you got out before for fairly minimal loss. Almost all of them hit their profit target except for this Capital One, but everyone else looks like it is over 25. So 11 and 1, average risk is, I'll do all those calculations and put them out at the end of the quarter, but obviously very strong. I was pretty surprised for the bullish pre-runners. So I'm not sure too many people were doing that in the environment we're in right now. Let's highlight, this is another kind of heavy one, bullish runners. So we're up, decent amount with 6 closed. This has more trades, obviously a lot going on, 10 open. So, obviously doing pretty well. I think the closed ones, those are all, hit their profit targets. So haven't had to close one out yet. But, obviously I don't think it'll win every time. We got a few that are down a little bit. But, I'm just tracking those, based off of either hitting a profit target or, the time expiration that we set for the testing. So those are done pretty well. We had no bearish pre-runners that actually hit. The bearish runners, I think there's 2, it's kind of break even right now. AMT was recent on 29th, so that's down a nice, Delta is actually holding up. This has I think 3 or 4 more days left to, turn it around, but, pretty flat on that. No, you didn't get a lot of those trades. Volrise, kind of real quick. Up a little bit. Had one close out for profit. The rest are kind of just chugging along. You can see here, we get out before the earnings. So, these aren't like, usually huge profit wins. You're pretty much like squeaking out, like 5% or something. But, they're usually decent trades. So, a bunch of these have earnings on the 4th. So these 3 will get closed out. But it looks like they're doing okay, at least profitable. And then Disney just triggered yesterday. So, if you're not seeing those, those alerts come via email, and you can just check them every day in the earnings under pre-alerts. So, the live ones will pop up here. So, Pinterest is a bearish runner. So that, came in today at 10 o'clock. And then, you can look at yesterday, and you can always go back in the time machine and look at those trades too, for the whole quarter and look at those. So just so you know, that's there, just to remind people. The other one is a non-mover. This one's not doing well. So it's populating the monthly instead of 2 weeks out. I'm still tracking it. It's down like 500. Basically, you had one really bad trade. This DHR. This one's not looking too good either. But you had a, kind of like a 50-50, almost. Maybe a little better than 50-50, but you're down, $500 overall here so far. But those still have time. Those are probably the worst performing out of all of them. So, and obviously there's a bunch of pre-runners that didn't populate just because of estimated dates and things like that. So that's it for the earnings update.
Can you leave that up for just a second? Just a second there.
What part?
I was interesting. I wanted to compare just 2 of these: the bullish pre-runner and the bullish runner, post-runner, if you will.
Yeah.
Between those 2, which one has been doing better?
Well, the bullish pre-runner did. It was like 11-1 and barely had a loss. The bullish runners, it's got a few that are down, but it closed out. It had a lot more occurrences. Already 16 with more to come. So these all 6 were winners, and then of the 10, you got 4 currently that are down. These are kind of break-even-ish. So
yeah, I've been actually using a kind of modified trade strategy there that's been working pretty well on those.
How do you modify it?
Well, okay, here's what I've been doing. I take the it's only it's kind of like a one strike wide width kind of thing. So I'll sell an in the money call. I'm sorry, I'll buy an in the money call. Once the strike that's low, first strike in the money. And I'll use the first strike out of the money as a, to sell both a call and a put. So I'll be, and then I'll sell buy a put higher than that to define the risk at the same width. So all these are the same width. So the maximum I could lose on the whole gambit here is the width of the strike minus the credit I pull in. And then on top of those two trades, I'll sell, well, the one at the one strike that I already have a call that's at one strike out of the money, I'll sell another call above that.
Okay.
So it's kind of like, it's like a butterfly. I don't know how you term this. You could probably think of it about 4 different ways, but it's 3 verticals. 2 out of the money credit spreads that finance a debit spread that's one strike, the one strike in the money and one strike it's 2 away. So the debit spread is actually twice the width of the 2 credit spreads. I don't know. Can you follow that in your mind? I mean, my mind sees it, but
I followed it about 2/3 of the way. Joe, did you follow that all the way?
That's about as far as I got too, Josh. But
if I pull up like an option chain, you can we can just
maybe that's a good way to do it. That's a good
you
way
can
to do it.
just circle or like annotate here.
I mean, I did this with Texas Instruments, and I think my risk was like 46 cents, and it was worth $7 when it was all over, and it was just a one strike thing, So it's like that.
Right. I'll pull up TXN here. Okay, so I got my pen out.
Okay, so if I was here doing this, and I did this just the day after earnings was released,
Right.
to the end of that week, whatever it is.
Okay.
Texas Instruments was all of one day because it came out on a Thursday, right? So
Right.
I don't know if that had anything to do with it either, because all of the IV comes out in one day, and it worked in my direction. So you have to have the direction right. So I would sell that one that you have there.
This one? I thought you were buying in the money.
I'm sorry, I buy a call there. You're right. You buy a call there.
All right. So I'm putting plus.
I sell,
This
something
one, right?
that was, one there. That's right.
So that's a minus. Call plus minus, right?
All right. Okay. Now go ahead and sell the 206. Sell the 206 call and buy the one. Yeah, buy the one below that.
Buy this one?
No, I'm sorry, the one more out of the money.
This one?
Yeah, so that's the credit spread. That's the the orange is hard to read there, but
got it.
Okay, that's the credit spread on the bottom side. Now, since now on the put side, I take the one that says 335 there, and I sell that.
Right.
And then I buy the one on top of that. So that's the put
on top or below?
The 241. So it's a credit. Okay. So I take in a credit for that.
Right.
So that's an out of the money credit spread, right? So, I'm sorry, an in the money credit spread I'm selling. I keep switching my modes here, but it's an in the money. So I'm taking in a pretty good credit for that. And that pretty good credit almost eats up half of the cost of the whole combination.
So what?
Because it's the day before. It's the day before, and all of the IB is pumped up.
Right. So what is the risk reward kind of ratio for this?
Well, like I said, when I did this, the exact numbers were like it cost me 42 cents to put on that whole package the day that Texas Instruments was going to announce that night. So it was a one-day trade, and so since there's 3 short options in this, there's a good chance that you might have to have do some trade manage, but you don't, as long as it you don't. If you can put this on. And when I looked at my risk profile, I was sort of surprised and amazed at the same time when I saw this, because there's a little flat area that all the shorts can expire out of the money, and your long debit spread can be both expire in the money, which means you net out as a plus plus, and you don't have to trade out of it. So your two short credit spreads can fall off total out of the money and at no cost, and the debit spread can have full value of the width of the strikes. Anyway, I could share a screen and show you how that worked out, and it's a little easier if I show it. It's easier to see if you see it on a price chart, but that's the theory. That's the theory. I wish I could sort of test that.
Yeah, but I don't think we have that kind of
anyway.
ad
Maybe
hoc.
I'll talk to line and see what we can talk about this. But that seems to, because you still have a lot of IV falling. I still have a lot of open interest, which is one reason why. And by the way, since this was only one strike, I think I don't know what the market maker was for Texas Instruments, but I think it was well within the market maker move. I had to go back and look at that on your time. But that trade has worked out pretty well. It's very low cost to get into because you're selling two credit spreads against one debit spread. And the obvious, you got to be right on direction, though. I'll tell you that you have to be right on direction, which is why I waited till after the news came out on the earnings, because then at least all the news is out and you can see that day.
Right.
So I put this on post. I think I might have misspoke when I said I put this on Texas Instruments came out with their earnings, and it's the next day I put that trade on. So it wasn't before earnings; it was just the day that earnings came out. But there's still at least one day in the week left before the options expired for that earnings week. Right. I hope I'm a little dyslexic. Sometimes I'll say just the opposite and have to correct myself, which is hard to follow sometimes. So
yeah, no, I get it. It's like, the day after earnings, you're getting into that.
All right. So anyway, just I'll talk to Joe offline and maybe we can straighten this out so we can communicate it better.
Yeah. It's interesting. Go ahead, Joe.
It is interesting, Dave. And I think that, you've got the vertical spreads, but I believe, and you said direction is critically important. Can were you looking for that stock basically to not move? Given that it closed around 177.
I'm sorry, it's got to move up enough to keep the put spread out of both out of the money. It's got to move up that much, and so it gives you a little bit of cushion between the two strikes that you sold the call and the put at the same level, like the butterfly level. It needs to be a little bit above that, but below the call spread, out of the money call spread that you sold as a credit spread. That gives you a little flat spot to have the price come to where you don't have to trade out of it. It sort of is a way to defeat the if we've all tried to trade out of a butterfly, we know how hard that is. Or if you try to trade out of a calendar right at the short strikes, the market makers hold you because it could go either way at the very last minute, and especially if it's a high beta stock, right? So the key here is to have the call spread and the put spread fall out of the money, and the debit spread to be all in the money. But if it's just part in the money, that's still a pretty good trade, because the biggest part of the credit received is from the put spread that you're selling that's in the money already. That's where the biggest part of this was like half of the trade, more than half of the trade, I think, was that amount. So you have to at least have the put part fall out of the money to have this trade work. So yeah, some direction enough, but if it's only one strike, it didn't have to be that much. That's kind of where that's my other thought process here. Anyway,
I mean,
maybe I'll give Joe a call out, and maybe we can share my screen and he can see better. I can explain it a little bit better. Interesting.
One quick thing, if I have the strikes right, basically you're long, the 75 strike, you're short the 77 strike, and then you're short that 80-82 call spread. So kind of, if I have that, and I think I have that straight, the takeaway for me there goes back to one of those critically important, where do you want the stock at expiration? And, without even looking at, 3 different vertical spreads, you sure as heck don't want it at 175 because that's your long strike. You are short that 177 strike. So that's really the target. And then, as you said, you're financing those, that debit because you're long the 75, short the 77. The 75 is going to be worth more. You're trying to finance that with that 80, 82, short call spread credit. So, and we can talk about it offline. My big takeaway from this in terms of where you want it, you want it close to that short strike, which is the 177.50 strike. But interesting.
Just a little bit north of the 2 short strikes that are your put strike and your short put and short call strike. Just a little bit above that is where you want to go. And maybe it was the 182, 187 and a half that I did. That was, or 182, 185 that I did. So there was a little gap between the 2 short strikes and the 1 short strike of the long of the out of the money call spread. I'm confusing people because I'm saying 2 things really close that are opposite, almost in the same sentence. Correcting myself. Let me talk to Joe offline, and we'll maybe talk about this next week if we think there's some validity. I'll call you after if you would. Okay, Joe.
Okay.
All
That's
right.
fine, Dave.
I've wasted everybody's time here already. Sorry.
All right. All right. Well, thanks, Dave. Definitely interesting. Let's move it over. We only got 15 minutes, Joe. You ready?
Yeah, just a couple of things to talk about. Let me see. I'll one comment that kind of caught my eye was, let me see. Are we? Can you see my screen yet, Josh?
Yeah.
I don't think so. Oh, you can. Okay.
Yeah, we got it.
One comment that caught my eye coming out of Seeking Alpha, a statistic about the earnings that are out there. What I read was the earnings season is turning out much better than feared. More than half of the S&P that have reported so far have beat, which is above the long-term average of 47%. So I had not seen that stat before. I guess long-term average, and how far back that goes, I don't know. But Seeking Alpha suggesting that 47% of companies in the S&P 500 typically beat. Right now, it's north of 50%, so better than expected. But over the last 5 quarters, 62% of the S&P have beat. So it just, it was a stat that caught my eye. Just wanted to pass it on. And then as far as charts, I did, always trying to think in terms of, money flows, where's the lead, and, going back to the dates. I don't know how these got all a little bit out of order, but, the first, big mover, big market to me that topped out, or that, basically had a top was the oil market. The oil market topped on June 8th. I had all these all teed up just right, Josh, and they blew up for some reason. Yeah. So, yep. So, and again, big picture movements. Basically, we're talking, a bear market from November, January to the middle of June. Remains to be seen whether, we've seen, the end of the bear or not. Obviously, that's been, discussed. But it was oil that topped out first, okay, June 8th. As it turns out, there's the natural gas market also. I'm not saying that's, one of the big moving markets, but that also topped out after, a 6-month run on June 8th. And you had, a sell-off, which, took you to the end of June in that market. But anyway, the commodity market there a little bit, June 8th led us. After that, we get into the bond market. And, with the moving rates, to me, it's been the bond market that's maybe most important to watch. But going back to the charts, it was oil that topped first. The bond market, basically bottomed out, rates topped June 14th. And, basically this is the 7 to 10 year. I think here's the TLT, same thing, right in this June 14th. So you had oil, topping out a week before rates peaked. We've had, a pretty good rally since. Now, when we talk about big bars, and Dave, I thought your point both on the trend line in the VIX and the reduction of the size of the move in the daily VIX bars, really pertinent. We had a big bar in the bond market yesterday. And, for the bond market, Gus has talked about this, for quite some time. Just the movement in that 10-year has been crazy over the last, X number of months. We basically topped out there, I think it was June 14th. And, we've had a rally ever since until yesterday. So, rates dropped in the 10 years low is about 255, 258. So we had almost a full basis point drop over the course of a month from 348 down to 258. We rallied back up to about 270, 275, 278 yesterday, which is where we are yesterday. But I think this bears watching, the fact that, we had a reversal in rates starting, the middle of June, had a solid 4 or 5 weeks of softening rates, and that seemed to change yesterday. So it'll be interesting to see, where the next week takes us, which kind of leads me to the news. We do have non-farm payrolls, which are this Friday. Last month, I think they came in a little hotter, just north of 370. The number for Friday is considerably lower. And I think this may go in line with what expectations were in June, but the number came in hotter. The range is basically 250 to 290 for the non-farm payrolls this Friday. I think, that's going to be the important next number. I think that will move the bond market. Bonds, though, maybe we've got that essentially 350, 250 range in the 10-year. Maybe we're going to, lay in that range over the next, as David suggested, maybe out to, Fed time in September. But we do have Jackson Hole sometime in August. So let me just pull up a couple more of these. There's SPX. So, SPX, Russell, and NASDAQ all basically bottomed out on June 14th. We had a rally, and then, we got into, the dollar, which here's the dollar. Basically, the dollar topped out on the 14th of July. And, we go back to the S&P chart. Here's the 14th of July. I'm not saying, and these relationships obviously change, but just, the big movement of money, there's the 14th of July, the S&P, Russell, and NASDAQ had a pretty good rally over the course of 2 to 3 weeks, a little pullback, dollar tops out, and you know, the market's kind of been off to the races ever since. So you know, I think that you know, Friday's number probably going to be pretty important in terms of, you know, major moves in the market in terms of the non-farm payroll. We have to go out to next Wednesday and Thursday when we get more, you know, inflation numbers again. CPI is going to be next Wednesday. PPI will be next Thursday. Get a bunch of mortgage numbers, which certainly, you know, is important data for the Fed. See whether the housing market has continued to slow. We also get inventory numbers, which I think, you know, in this market of, we're basically in a range now, and the Fed, you know, Powell said himself, you know, we're watching the numbers. So it's a news-driven market. Josh mentioned, you know, listening to Powell's minutes and the Fed minutes. Josh, you know, does that regularly. I had never done that until, you know, the last meeting, and I just found, you know, that whatever it is, 30-minute conversation to be incredibly insightful and educating. You know, by and large, you know, you get past his statement, you know, which is going to be somewhat tepid. You know, the questions is where, you know, for me, you really got to learn. And anyway, I would just endorse Josh's comment earlier. If you haven't listened to those, you know, Fed minutes before, I would encourage you to do it in September. Found it to be very enlightening. So anyway, always looking for the big, you know, the flow of money. I think flow right now is kind of, we're range bound. And it wouldn't surprise me if going back to Dave's VIX trend line, if that trend line breaks, and I think that may be an awful good signal. And, you know, we'll see whether it's news that can generate something like that. But I would think that would be a pretty good catalyst for higher prices. So that's all I wanted to cover. Sorry, the charts were less organized than I had them before the call, but they got a little messed up. So any comments or questions, open to them. If not, Josh, back to you.
All right. Does anyone out there have a question there? No? No, I think that's it. Then we ran our 55 minutes here. So, you know, I think that's it, Joe. So, you know, just thank everyone for tuning in. We'll do it again next week. And no, thank you. That's it.
Have a good week, everybody.
Thanks, guys.